So today, we're going to cover one technique that is part of the strategy our investors use to create income in their portfolio, regardless of whether the market is going up or down. Our strategy has helped thousands of clients enter a worry-free retirement by creating monthly income from their investments, income that can replace the paycheck that you're receiving in your job. Most of us think about what we will do when we enter retirement. Maybe you have visions of beaches or relaxation, maybe traveling to the mountains, golfing, fishing, spending time with the people that you love the most. But regardless of what you want to do, you need an investment approach that will provide you with the financial independence to do it. What do you not want to experience in retirement? What would it feel like if you were living off of just Social Security? What if you really could not afford the quality of life that you deserve in retirement? So imagine just sitting in a recliner day in, day out, watching TV and growing old. Most of us want to experience more in retirement. Oftentimes, investors make the huge mistake of continuing to do what they've been doing with their investments, even though they have significantly different objectives in retirement. Maybe that's partly a response to the limited choices available when it comes to getting income from your investments. So I was recently asked by a client, what do other retirees do for income? Well, typical retirement investments include bonds, annuities, real estate, or a balanced portfolio. The old stale investment rule of thumb says that you should move to more conservative investments in retirement, so the natural answer is bonds. However, because they are a more conservative investment, as a bondholder, you must be willing to accept lower returns. But consider this, fortunately, everyone is living significantly longer these days. It is very possible that you could live nearly 1/3 of your life in retirement. Will you be able to truly maintain your desired standard of living on paltry bond yields? Most retirees are quickly realizing that they must continue to take on some risk for their portfolios to last throughout their lifetime. So common fixed income investments include money market funds, CDs, and bonds such as Treasury, municipal, corporate, or high yield. In our current zero interest rate environment, nearly all of these offer low interest rates, and although there is likely a return of principal, there's no growth in principal. In addition, any increases in interest rate will have a negative impact on your portfolio's value. If rates increase, bond prices drop. Next, let's take a quick look at annuities. These are some of the most common and confusing investments. And this is unfortunate because most investors fall for the high-pressure sales tactics and have very little understanding of their contracts. In reality, investors can easily replicate the results of an annuity with lower fees, greater liquidity, and more control. Now, real estate is an investment commonly associated with income. As one of the higher income earning products, it comes with a unique set of risks. Significant cost to enter, lack of liquidity, hassles of ownership, complex structures, and taxes make real estate one of the most difficult assets to manage. If recent history has taught us anything, even this asset class is susceptible to downturns or even bubbles. The traditional 60-40 stock and bond portfolio is still used as the traditional yardstick. This is another example of investment advisors attempting to hammer a square peg into a round hole. With little to no emphasis on income, retirees are left with a 4% withdrawal rate advisors have recommended for years. Now, we will address this issue extensively in our third and final video.